pleased to say right now, joining us in studio is Erin Gibbs. Great to see you in person. Of course, she is the senior partner and chief investment officer over at Main Street Asset Management. Happy holidays to you.
Happy holidays.
It hasn't been a happy holidays for the market so far, despite the rally that we're seeing today. But a lot of people looking forward to 2023. The overall, I guess, general consensus is that maybe the first few months, first couple quarters could be a little bit rocky, but there might be a light at the end of the tunnel in the second half of the year. What are you anticipating?
Right. So right now, when we're looking at just profit expectations, what we're expecting the broad market to do, profits are expected to contract for the first 2 quarters. So we'll see those negative profit growth, and then it'll slowly start making up and picking up in the second half. Now, still the outlook is not exceptional. We're looking at 4% profit growth for next year for the S&P 500, which is most likely going to be below the rate of inflation. So, net, they will ultimately be making, in inflation terms, less money. But you've really got to pick apart the winners and losers for next year, because when you start diving into different sectors and really even breaking it down into different industries, there are some very clear winners where companies are expected to have extraordinary gains and their expectations have been very stable, and then other industries that are just being devastated.
Do you believe in a lot of these sort of, I should say believe, but I guess do you follow some of these sort of almanac narratives, the idea that, well, when you have a down year like we're having today, where we're down like 20% in the S&P, that historically you're going to get a gain in the following year?
Yeah, so about 75% of the time after a down year, so 75% after a down year, you get an up year, and the median return is 20%. So if we followed statistics perfectly, next year we get 20% return.
You're smiling.
I feel like there's sort of a caveat or a fuck there.
Now, the likelihood, yes, of there being right on the dot. But look, the only 2 times that we've ever had back-to-back losses in the S&P 500 was 74 and 73. So obviously a very different world of very persistent high inflation. And I think
none of us were alive for that.
Yeah. and then also 2001, 2002. Yeah. Now, the good thing, if we're comparing to the aughts, the early 2000s, the valuations were astronomical. We're talking like 40 times, 30 times, and we're trading at 17 times forward PE. Yeah. So the likelihood of, having to correct like such an overcorrection of that is just, we're already there. We're already down towards fair value.
Yeah.
So,
but does price come down more, or do earnings move up at some point?
So at this point, even if earnings are revised even slightly down, we're still looking at healthy valuations. So at least I think it's more that it's less likely that we're going to have another negative year, just because we are already getting to somewhat of a cheap valuation. There's more potential for upside if the market does do well.
From an industry group perspective, where do you want to be in 23? If we look at hindsight for 2022, energy was certainly where you wanted to be. Where do you want to be in 23?
So I'm looking at, the 2 industries that are really standing out are, entertainment, hotels, resort, leisure. They're looking for 140% gains for next year. So still coming off of that pandemic slowdown.
Yeah, anyone who's looked at hotel prices over the last few months would certainly understand that. The question is, where are consumers going to continue to pay for that, though?
Certainly the expectations are that's the one thing that consumers are still willing to pay for. They may not be going out and buying, car expectations, houses, all of that people aren't, but having time to go out and enjoy yourself, vacations, that type of thing, seems to be the one persistent area that consumers are willing to spend on.
Erin, 2022 was one of those years where so many things that were unexpected happened. And I think about, Romaine was saying at the top of the show, here we are, the Russian war in Ukraine. It's almost a year in. Nobody thought it would go on for this long. It came out of nowhere, and it really turned things upside down. Is there something that you have on your radar that says, obviously you can't predict a black swan, but is there something that you're watching closely that could cause some troubles again next year?
Well, certainly, obviously, China. That's if they don't recover, any type of global recession will be extended because they are obviously a very important part. And so, we've already seen oil changing today just on reopening. So I think them being willing to reopen, getting their economy back up and running is certainly a possibility.
Yeah.
If that doesn't happen, we could see the recession in the U.S. much more protracted.
There's also a question about the relationship with China, the economic relationship, and
course.
we know at least that's somewhat fraught right now.
Yep.
And I'm curious, though, at least for U.S.-based investors, is China something they can really count on, whether it's the consumer growth that they have there and how that feeds into U.S.-based companies, or even the U.S.-based companies that depend on them for manufacturing and assembly?
A la Tesla, Apple.
Yeah.
right?
Yeah, more so on, it's really just a few technology companies where their revenues are important in China.
Yeah.
It's really about the products and basically the parts, the supplies that are coming from China into the products in the U.S. that are what's going to be driving, I don't know, a lot of the productivity here.
Aaron Gibbs, good to have you with us this afternoon. Thanks for swinging by the
Happy New
studio.
Year.
Thank you.
Happy New Year.
Appreciate it.
Yeah,
Aaron
doing
Gibbs
well.
of Main Street Asset Management. Now,